there, everybody. This is Craig at Max Trading. I'm here along with Eusebio today, and it's our pleasure to welcome you to our real-time trading session. We really appreciate you choosing to spend a little time with us today, and we'd also like to extend our very best wishes to you and your family and your friends during these times where health and safety is a concern. Hope you're all doing very nicely, well, and safe. If you like to trade trends in your preferred choice of markets, whether it's stocks, forex, futures, gold, or other markets, you need an effective trading system, and Max is the very best in trend following systems. So today you will get to see Max methods at work on the real-time charts, and I really like that because everything is exposed. There's nothing that can be hidden, nothing that can be exaggerated. You get to see it as it really is. Max courses teach you these trend trading methods and provide you with the indicators and templates as well, with classes beginning next week on Thursday, so not much time left. But please do me a favor. Don't wait until Tuesday or Wednesday next week to sign up. I have another video that you need to watch before the first session and a few other study materials as well, and I'll send all of this to you early so that you can be prepared and ready for that first class. Of course, we never know what numbers will be reported in the news release, and today we have the NFP, but even if we did know, we should have a great idea of how the market will react. Sometimes it makes sense, and sometimes it just doesn't seem to make sense, and we're not quite sure what the big boys are thinking. But we hope to see some good price action today, and if not, then Eusebio might decide to force a trade, which just means that he might enter a trade that Max traders would normally not take because it would be too risky. In other words, we understand that it's a risky trade. We know it doesn't meet the requirements of the entry rules, but the trade is entered just so that you can see how Max methods protect the account and can take advantage even of weak price action. Eusebio is here to lead us in this session, to take us right into the Max charts, and I know that a few of you here today are meeting Eusebio for the very first time. You will be pleased to discover that he is a very skilled trader, also a great coach, and he really enjoys helping other traders. So this is a good opportunity for you. I hope you can listen and watch carefully. You'll learn a few things. And please do feel free to ask questions in the question panel of your GoToWebinar screen there. Eusebio, I think that's enough preliminaries, and we're ready to get going. And our thanks goes to you for sharing your time with us today. The microphone is yours.
Thank you very much, Craig, for this introduction. Hello, everyone. Welcome to this presentation of the Max Trading System in the context of the non-farm payroll news release. I don't believe it's an ideal time for that news release because Good Friday is a bank holiday in many countries around the world, and then we are at the eve of Easter, so it's not an appropriate time to trade, and we see that today low level of activity, probably low level of volumes too. But because the non-farm payroll is always an important news release at the beginning of each month, so it pays off to observe that news release, and sometimes there may be some good opportunities. My analysis of the non-farm payroll is the following. When we have to analyze the non-farm payroll by itself is not significant enough. It's not relevant enough. We have to consider the non-farm payroll in combination with the unemployment rate, and then possibly as an addition, as a booster, the average hourly earnings month over month, which is one aspect of the inflation of a country. And all these news must be in agreement with big deviations to provide sustainable and directional momentum movement, so in the different pairs involved with the non-farm payroll, and I would say pretty much all the pairs. And what does it mean, a big deviation? Let's suppose, for example, we have good numbers. The forecast for the non-farm payroll is 652K. We need to have a number way larger, 900. I estimate it to 900K or more. And we need to have also an unemployment rate smaller than what is forecast. The forecast is 6.0, and I consider that we need to see an unemployment rate below 5.8%. And in addition, if these two numbers are in agreement, it would be good to see also an average hourly earnings higher than the forecast. And in this case, then most probably because there is never 100 certainty. It depends how the market, what the market is expecting in the future, of course, but also how the market has possibly anticipated or not, or how the big boys are manipulating the market. But usually, this kind of situation, so with big surprises, big deviations, should be positive for the US dollar. And so we could consider going long on the US dollar. Going long on the US dollar means shorting the pound US dollar, shorting the Aussie US dollar, shorting the euro US dollar. On the contrary, if we have big negative deviation, so non-farm employment change way smaller than the forecast, and an unemployment rate way larger than the forecast, and possibly an average hourly earnings smaller than the forecast, then this should be a bad situation for the US dollar, and the US dollar must be considered as bearish. And so going short the US dollar means, for example, going long the pound US dollar. And so we need to wait for the data to be released before considering any possibilities. If we have a big deviation in one direction or the other, I will explain what is the usual or what are the usual movements we can see on some of the chart. But for that, we need to wait for the news release, or for the calendar. Let me display the Forex Factory calendar. So here, in a few minutes, so in 5 minutes and a half, we will have the three numbers. What I'm going to do is I'm going to make this screen very small in such a way that I will have the calendar just under my eyes while observing the chart, or some of them at least, and then I will explain some component I have on my screen. So this way, yeah, this will make it so it will be good enough. Okay, and so if I consider a chart, any chart, for example, let's consider the pound US dollar. On the main chart, of course, we have the price. I'm using the 5-minute time frame. Then we have some of our max indicators. So we have in yellow and orange what we call the ETF lines. We have in gold our momentum line. In dotted lines, gold and green, our Bollinger Bands and trading wheels, and then our home base and home base channel. And then we have one momentum oscillator, which is the RSI, the stochastic of the RSI, which is used to give some confirmations of our entry setup, but which is used mainly for our exits, or some of our exits, because we have several categories of exit setup. And then we have our companion indicator, which gives technically the trend to follow. The green and red line gives that trend. When the line is green, we have to consider long trade. When the line is red, we have to consider short trade, but we have to take also into account the global context. And so if the global context tells, for example, that the pound US dollar must be taken long, we will consider only the long trade when our slow bias, this green and red line is called the slow bias, will be green. If we consider, for example, the pound Kiwi, my bias for the pound Kiwi is going short for the pound bias, and so we will consider only the trade, the short trade, when the slow bias will be red. So we have always to trade in agreement with the global bias, because I consider that any serious trading system is always based on three pillars: the technical system itself, then the trade risk management and money management, which consists in how to handle the trade and how to grow an account, or how to handle, in that context when we are facing losing trades, how to handle a drawdown. And then the third pillar is the global context. We trade only in agreement with the global context. Now, if we have a look on the US dollar pair, especially the pound US dollar, we can see that during the entire day, the price has moved sideways with no real direction. The range was even not 25 pips, so no directional bias in the price. For the pound, for the Aussie US dollar, we have a similar behavior since the beginning of the day, so the price is not moving. It's going sideways in a range which is around 20, 25 pips. So no clear directional bias. And if I take the Euro US dollar, we will have a similar behavior with a range of around 20, even not 20 pips. So even not 20 pips. So no direction. Impossible to say if the big boys are anticipating good news, bad news, or if they are manipulating the market. So for me, we need really to wait for what the news is and then react to the news. Well, so we have just to wait for now 1 minute and a few seconds before the news release. If you have any questions about the component or any other subject I may possibly explain, feel free to post your question in the question area of GoToWebinar. For our Max members, we have our private chat room, which is opened, which is the usual website. So feel free to log in into the chat area, and you can post your comment or your questions also in this area. So let's redisplay the calendar just to be ready when the news will be released. And we don't need to rush. It's not because we'll have the data, and even if there is no big surprise, so there will be no tradable situation. But even if there is some big surprise, we don't need to rush, because 2 minutes after the normal news release, there is the revision, which is not often mentioned in the calendar, but which may create some volatility. So I will take out that note for a moment from my screen, just to observe what the pairs are doing while the news is released. So it seems that we may have possibly some good news. So let's see that, but not a lot of reaction. This spike is only 13 pips, so not a big deal. For X Factory, so let's try to update. So we have 960K for the non-farm itself, but and so you see this was my criteria to have a good number for the non-farm payroll itself, but the unemployment rate stays at 6%, so no big deviation, no surprise in the unemployment rate and in the average hourly earning. So minus 0.1, so not enough. So just a little negative. So we have contradictory informations. And so it's not a surprise to see that there will be no good reaction in the market. This may be even a disappointment. And so if this is a disappointment, this means that probably we will see the US dollar weakening. I may be wrong, of course, but we have to wait and see what the price will make. So let's wait just a few moments and we will see. So the best pairs for the moment, the best moving pair, but with not a big range, was the pound kiwi, which is one of our favored pair with the pound Aussie because it moves a lot. So there is no reason to change the bias, so no surprise in the numbers, or not enough surprise in the numbers. So I will keep, for example, the same bias for the pound kiwi. So a short bias for the pound kiwi, but we need to wait some retracement. This means that the money is moving from the US dollar to other pairs. We may have also a weak pound. Let me check on some other tools I have. Yeah, we have a weak pound. We have a strong kiwi. So the pound kiwi for the moment is for me the best pair to consider. But we need to wait for the appropriate setup. And so generally when we are seeing a long bar like the one we are seeing now on the pound Aussie and the pound kiwi, similarly on the pound US dollar, so the Aussie US dollar, so we have to wait some pullback. These spikes are not big spikes, so we have a spike of 40 pips, which is not a big spike, so on the pound kiwi. Yeah, Chris, the revision always happens 2 minutes after the news release itself, and so the revision has been released 1 minute ago, in fact. So, and in some calendar, the revision appears. In Forex Factory, I don't know why they consider that it is not important enough, simply because the revision of the non-farm payroll can be made several times during the months. And so the data which have been released today may be revised several times during this month until the final revision. So, Chris, I have taught in the course, in the session dedicated to the news release, that there is a book you have to read, which is the Bible of the news release, which is called The Secret of Economical Indicator or something like that, written by Bernard Baumhol. And so this is described in great detail. This book is very, very technical and so very, very boring to read, but it's a very, very educative book. And so if you study this book, then you will learn all the details of this kind of news release. Yeah, we can make a small look, a small search while we are waiting for some here. Baumhol, Bernard Baumhol, and the name of the book is here, this one, The Secret of Economic Indicators. The Secret of Economic Indicators by Bernard Baumhol. Bernard Baumhol. So The Secret of Economic Indicators. Okay? And if you go on Amazon, for example, if I take this link and we go on Amazon, I will take the general website. So here, this one, or one of the previous version. So let me take this link, and I will post this link in the chat area of GoToWebinar. Okay, I posted in the chat area of GoToWebinar. Yeah, it is in English, indeed. It is in English. So it seems that the US dollar is a bit strengthening, but not too much. And so what is it, when there was a big surprise, which was not the case today, but when there is a big surprise, what is the typical behavior of the price. Let's take, for example, the pound US dollar, but it's true also for the Aussie US dollar, for the Euro US dollar. When there is a big surprise, you will see generally a spike. This means a very long bar, usually in less than 1 minute. And generally that spike will indicate the direction to favor in the trades. But this spike is extremely difficult to trade because the price is moving so fast, and the spread usually, if you observe carefully, during the spike for a few seconds, the spike will increase. You see, in this example, for the moment, the spread for the pound US dollar is 1 pips, sometimes a little larger, while usually on this platform I have almost zero spread. And so the spread is rather wide. Then, in a second step, which can last several minutes, sometimes 5 minutes, 10 minutes, half an hour, the price will make a pullback. This pullback can be a small pullback or a deep pullback. We never know in advance the depths of the pullback. And then in a third step, the price will reverse in the direction of the original spike, making what I call the fundamental movement. But here I must admit that with contradictory information about the three news, which must be analyzed together, I have no idea what the price will do. Today there has been no bias, no directional bias. The price was going sideways on almost all the pairs, and so no news, no surprise, so no change in the bias. If you consider, for example, the Euro US dollar, you see also on my chart some horizontal line. These lines are what I call possible supply and demand level. We establish every weekend, every Saturday, and they are valid for the entire week. So this weekend we will update them. But you can see in the case of the Euro US dollar, where the spike of this blue candle has stopped, in the proximity of this demand level. So these levels are really very accurate, and the price nicely responds to these levels. If we observe, for example, in the past, you will see how these levels react sometimes as nice support or nice resistance levels. You see here another level. You see here how the price comes very close. You see here right on the pip or on the pipette, established 1 week in advance. Okay, and we do that for almost all the pairs. So now we have to wait for a valid setup, and I will consider the most moving pair, which is so here the pound kiwi, which is still the pound kiwi. And if we get some setup, so I will show you, I will force a trade, and I will show you how we handle a trade with the max. Yeah, it is reversing indeed, but my bias, Chris, is still to the downside for the pound kiwi. And so this means that for the moment the price is making a pullback. The pullback is deep enough to reverse the slow bias, but because the slow bias now is not in agreement with my global context, I have to wait for the price to come back, and then when I will have a short setup, I will consider the trade. I will force the trade. Like in the pound Aussie, in 3.5 minutes, we will have perhaps a short setup in the pound Aussie. But the conditions are not appropriate to take a trade at this moment for several reasons. First of all, so no surprise in the non-farm payroll, and then a low level of activity with many countries on holidays because of Good Friday, and with a long weekend, the weekend of Easter. Don't forget that on Monday, many countries will be again on bank holiday due to Easter. So personally, I will not consider to open my screen on Monday. Yeah, this is where indeed, Patrick, I completely agree. Patience and discipline comes indeed. You know, there is no need to take a trade as soon as you open your screen, your monitors, and your chart. You need to wait for the price to come to you. Of course, you need to wait, and waiting is boring. But trading is boring in itself. But it's by perfecting your trading process that you will improve not only your skills in trading, but also your results. The results comes when you execute a perfect trading process, in fact. And the perfect trading process is waiting the perfect setup. So when you have a good setup, then you can take your trade. I will add my max trade monitor on the pound Aussie because I see that setup is possibly appearing in the pound Aussie. I have 1 minute and a half, and I would be ready if the setup is confirmed. Let me check. Yeah, we are in auto trading here. Load a 1% risk presets. I will not notate the charts, the trades. Okay. And when appropriate, I will explain so these two panels. There is no trade for the moment, Desmond. The conditions are not appropriate to take a trade. So what I will do for the rest of this session, so I will force a trade and illustrate our trade risk management. And this will be an opportunity to explain some concept of the max. And so this tool I'm using is our tool to handle our trade. It is a one-click button trade to open and close the trades. And I will explain, in fact, what I will do. This horizontal red line is our stop loss. It seems that the price is coming back. So my bias for the pound US dollar was flat. For the Aussie US dollar, it was flat. The euro US dollar, it was flat. The pound Swiss, it was down. The pound Kiwi down, and the pound Aussie flat. So not clear. So many indecision today. This red candle is not a good short setup because, of course, the slow bias is green. We have to wait. The setup has been invalidated in the pound Aussie, so we have to wait for the next one. The price seems to come back in the pound Kiwi, but we have to wait for the appropriate setup. And all these setups, if some appear so, are not reliable at all because we don't have appropriate conditions to take a trade with the non-farm payroll today. Let me explain what we have here on the trade, the max trade monitor. I will also apply it to the pound Kiwi max trade monitor, so here, because I like the pound Kiwi. Pound Kiwi, pound Aussie. So the small button is the button panel. Do you need the navigator window? Could you close them so that your charts are bigger? No problem, Desmond. No, I do not want to close my navigator and market watch panel, but what I will do on the appropriate moment, I will widen one or two charts, depending where I will force a trade, in such a way that you will have many more details on the chart. So just a few minutes of patience, okay? So the small panel is made of button, we have a buy or a sell button depending where the stop loss is. So if the price is below the stop loss line, the button will be a sell button. If the price is above, the button will be a buy button. And then we have an MX and an XXX. The MX button is used to close half of the trade size, and the XXX to close the remaining position. This is important not in the version I'm illustrating here, which is the max primer and the max light, but it is important for the max standard when we can possibly scale in. And so whenever we use the buy or the sell button, we will make a scale in, and each MX will close 1 unit, because whenever we open a trade or a scale-in, we consider the trade is made of 2 units having the same size. And so the MX is a scale-out. So we close 1 unit, and the MX close all the remaining opened units. The RP and the CP button are simply to control some of the options of the data window. The data window represents essentially either for the symbol we are trading or for the entire simultaneous trade we are handling. So it gives 2 main information. I will not describe all the details information, but it gives the result on the stop loss. So what is the result if the price hits the stop loss, wherever the stop loss is placed or adjusted, and the XXX profit will be the result of the trade if the trade is closed on the present moment. So, and there is also the size of the stop loss, the spread, and the risk on the entry. And all the other informations are just complementary information, which are not necessarily essential for the trade. For the pound OZ, the market sentiment has completely changed, as well as for the pound Swiss. So I will consider now the trade in the opposite direction. And let me set also the max trade monitor on the pound Swiss. The pound Swiss is not moving a lot for the moment, or I hesitate. There is no reason, but I would like to force a trade. So we may have possibly a long setup on the pound OZ here, but we have to wait for this candle to close, and the sentiment is changing also for the pound Kiwi, but it's too early. So let's wait for the possible setup on this pound we have. So let me widen this screen now. And so let me check if this setup is a valid one. The candle is a bit long, but I want to illustrate the trade risk management. So I will set my stop loss somewhere in this area at around 30 pips, yeah. And then I make a buy. No, it's too late. The price is escaping. So let me check. Yeah, let's follow the trade. I make a buy. So the trade is opened, okay? Don't take that trade. Don't take that trade. Silver and 3, there is a replay which will be available. So I have forced trade. Don't take this trade, okay? Because these trades are forced trade. The conditions are not appropriate to take a trade. Now you can see that with this trade, my risk was 1%, is 1%, so minus 0.99%. So a little less than 1%, because when we open the trade, and I can show you that on the terminal panel, you see the minimum size I can trade is the micro lots, and so the trade has been rounded off to 0.36 lot or 36 micro lots, representing 1% risk for this trade. If I close the trade now, I will make no profit. So my result will be 0% or minus 0.01. And if the price reverses and hit my initial stop loss, my loss will be around 1%. And you can see that when the price will move upward or downward, the XXX profit will change, representing always the result I can have, positive or negative, if I close the trade at that moment. And of course, the aim is to try to reduce the risk here progressively with two possibilities: either the stop loss adjustment when the price will move in favor of the trade, or by closing one unit. We have two open units. Each unit represents half of the trade size, or 18 micro lots. And so when I will close one unit, possibly with a profit, I don't know, but this will reduce the risk. And if the unit is closed with a profit and then adjusting the stop loss, most probably the trade will become risk-free or almost risk-free. And this is what I would like to show you. Now, because the circumstances are not very good to trade today, what I'm going to do is the following point. When we open a trade, you see the green horizontal line represents the entry level, the red horizontal line represents the stop loss. In order to reduce the risk if the price goes against us, is we define what we call an invalidation zone area. The stop loss size was 32 pips and half, and we define, in fact, the invalidation area at mid-distance, or something like 16 pips, or somewhere in this area. Okay, we don't need to be absolutely accurate. So I will draw an horizontal line in this area, which will represent our invalidation area. What does this mean? This means that if the price retraces and hit that level, in order to reduce my risk, I will close one unit with a small loss. Similarly, here, at 16 pips above the present price, I will set my plus the spread, and the spread is, what is the spread? The spread is between 1 and 1.5 pips, so I will take 7.5. So here at this level, this will be my minimum level for profit taking. So normally, what we do in terms of using the exit technique, whenever we have an exit technique triggering, we have to close one unit. But when we are much more experienced with the max, we can use sometimes some flexibility. And I call that flexibility the discretionary decisions. And we cannot be subjective, in fact, in the way we decide to make our exit, but we have some flexibility which are well defined. And my discretionary decision here is the following. I will ignore any exit setup as long as I cannot close one unit on this blue horizontal line or above. There are some reasons why I use that discretionary approach or decision, which are linked, in fact, to the difference in profit on a long time period. So this is why I'm using that discretionary decision. And we like to draw with a magenta, a green dashed vertical line, our entry setup, which was in fact this candle. Okay. What was the entry criteria? William, the entry criteria is what we call an entry setup. And the entry setup is a specific price pattern fulfilling a certain number of conditions. And these conditions are, of course, taught in our course. So I will not explain them so here today. Let me check that. Okay, I'm good. So they correspond to, first of all, a specific pattern, and we have several types of patterns to define entry setup at the very beginning of a new trend. The entry setup must also fulfill the risk criteria. Do we have a correct risk associated with the setup? And are we taking that setup in agreement with the global context? And so here my global context for the pound Aussie was upward. The news has not changed the context, so I take only the long trades. Okay, and we will have similarly exit setup. The exit setup will correspond to a situation when a risk appears for the trade, and these risky situations are based on several types of exit technique. We have exit technique based on an indicator, for example, the store RSI. We have exit technique based on pure price action. For example, when we have a long bar in favor of the trade, this long bar is always a nice exit setup. We have exit setup based on a combination of price action and an indicator. And we have also other criteria for our exit setup when we day trade, especially so time constraints. A very important time constraint when we have nice trend will be the end of the European session. When we are in a situation we call a true trend is a very specific type of trend we see during the day. That moment around the Frankfurt and the London close, which correspond to the European session close, will represent an important time period, a critical time period, which will represent an important exit setup. So, of course, the end of the day, a pair like the pound US dollar can be traded even after the London close. During the second half of the US session, of course, the end of the day would be also a critical time period for day trading. So hold on one sec. Sorry, I have a small frog in my throat. We are now entering into a specific period which is spring and with a lot of pollen, and I am a bit sensitive to some pollen. So let me take a small sip of water. This will help me. Okay, that's fine. Let me have a quick look to some other pairs. So the pound Kiwi. Let me check the pound Kiwi. Now the sentiment is also reversing for the pound Kiwi, but it is not a strong sentiment and nothing special on the other pair. So I will stick to the pound Aussie just to illustrate what we are doing. The brown vertical lines and the red vertical lines represent, Desmond, very important lines. We have they are not brown, they are orange, in fact, okay? And the first orange vertical line represents the Frankfurt Open. Then we have the London Open. Then we have the US Open, the New York Open, the Wall Street Open, the Frankfurt Close, and the London Close. And then in red, you see here there is a red line. If I make a zoom in, we will see it perhaps a little better. This represents the news release with the non-farm payroll. And so every day when I start my trading session, I begin to draw all these vertical lines. I usually open my charts half an hour before the Frankfurt Open, and so I draw these vertical lines. It takes me just a few seconds to draw them. I don't use any indicator for that. I do that manually because this forces me to watch what the price has made also during the ASEAN session. If you use an indicator, in fact, to do that automatically, we lose the benefit of seeing what the price has made during the ASEAN session. And these vertical lines are important because when we have a market open or a market session close, we may have some increase in the volatility. And we have to take that volatility into account in our trading process. Now, this red candle, you can see an example of exit technique given with an oscillator, a momentum oscillator like the store RSI, is when at the close of the candle, the store RSI will make a top. And so, but because the candle will close not in the appropriate place I have explained previously, for my discretionary decision, I will ignore that exit setup. In the presentation we have made last week on Saturday, I think, so I have explained another way we can use the store RSI, which is the divergence. Let's see if I can illustrate an example here. You see here the price is moving downward. The price was temporarily in a downtrend, and the price was making lower lows. Of course, with the news release, it's not very significant, but it is just to explain the concept. And at the same time, the store RSI is making higher lows. So this is one example of a divergence, and such a divergence, and there are several types of divergence. Such a divergence may be an exit setup. And so it may indicate when to at least partially close the trade. Yeah, it depends, Silver. Oh, April and May is always a difficult period for me, especially when we have a dry weather with a lot of sun but a lot of pollen too. So my throat is a bit too sensitive to the pollen. And see, it is extremely important before taking any decision to wait for the candle to close. It's extremely rare to take a decision to close one unit before a candle closes. We have some exit technique requiring to take a decision before the candle closes, but for most of them, we wait for the close. Or I'm living in the northeast of France. In the northeast of France. Approximately at mid-distance between Paris and Strasbourg. I'm not French, I'm Belgian, but I like to live in France. Okay, the price seems to come back now. I don't see other opportunities I can use for illustration on the other pairs. Let me check. No, not really. Perhaps the Aussie US dollar short. Yeah, let me take the Aussie US dollar. So what I'm going to do is I'm going to close this terminal panel and widen so the Aussie US dollar, and I will keep so the pound Aussie. So this way. And I will keep them side by side. And for the pound, for the Aussie US dollar, so I will consider short. So let me set the max rate monitor on the Aussie US dollar that way. And we still see enough details so on the two charts. Aussie US dollar, where is my stop loss? And for the stop loss, it is here, so far away. So this means that the price is not moving a lot. We are in a downtrend and it's not too late, so I will set my stop loss where? On this place, and I will open a short trade, so here. So one long on the pound Aussie, one short on the Aussie US dollar. And I will set so my minimum level for a profit here at how many pips? So it was so 12. Half of that will be 6 plus 1. Let's say 1. The spread is, where is the spread? Or less than 1. So let's take 1. So at 7 pips. So here at that level. You see, I have also a risk of a little less than 1% of the Aussie US dollar. But again, I repeat, the conditions are not appropriate to trade. This is just to illustrate how the trade risk management is working with the MAX. Now you can see that now globally, in the global column, you can see that if I close the two trades now, I will, let's say, virtually break even or with just a tiny profit. The pound Aussie is making a small loss, but the Aussie US dollar is making a small profit. And now the prices are accelerating in the right direction for both pairs. Just to illustrate the trade risk management and the trade risk control, because the time is flying. We are almost together for 1 hour now. I don't know for you, but for me the time is flying very, very fast. What I will do is, if the price on the Aussie US dollar reaches my minimum level of profit, I will close 1 unit. We can see in the terminal panel the size of the trade for the Aussie US dollar. It's 72 microlots. Okay, 72 microlots. So 72, this means that half of that is 36 microlot, and you will see the MX button will close half of the trade. Now, in order to show a little more details, I can make a zoom in, if you prefer, on the chart, so that you will see more details. Ralph, Caen is in the west of France. I have friends living in Caen, indeed. Question, how many pips does the currency usually have to move before you realize a decent profit? It depends on the size of the stop loss. For me, I consider the minimum distance the price must move correspond to half of the size of the stop loss I take. And we have rules to fix the stop loss size. Or simply because my my bias for the Aussie US dollar VIC has changed from flat to the downside, but these biases are not reliable at all today. Okay, there are no element in the global context to tell us in which direction to trade. So I want just to illustrate the trade risk management. So in this case, okay. And you can see how the price can reverse very quickly in both directions, so with small movement. The movements are really small. If you take the pound Aussie, which is one of the most volatile pair, the distance between the highest high and the lowest low of the day today is only 68 pips, when usually it is more than 100, 120, 150 pips, so very, very small movement. You see, for the Aussie US dollar, the distance between the highest high and the lowest low of the day is only 38 pips, 36 pips, so no movement at all, okay? I have no preferred pairs to trade. We have a process to choose the pair silver. Let me explain while we are waiting how we proceed. So here on our web, which is maxtradingsystem.com, we have a specific page which is called the News Watch. And this News Watch is freely available for everyone. I will post the link in the chat area of GoToWebinar in such a way that you can access that page at any moment. And when you want to be informed when it is updated, you can put your name and your email address on the same page. And on this page, we provide, first of all, a list of geopolitical elements we have to pay attention. I have recently added one specific line, which is it is here the new class action made in Germany here against the PEPP, so which is the Pandemic Emergency Purchase Plan or Program by the ECB. So they are contesting that. Then below that we have a simplified calendar where we consider only the news which are really important. We ignore all the news who are not important at all, which have never effect on the Forex. Then we have the top pair list, which represent the best moving pairs. And this list may somewhat change from week to week, of course, but we have the most moving pair. The max is the trend following system, so it's better to trade trending pairs. And then when we match the economical calendar with these best moving pair, we have a choice of pairs for each day of the week. And the pair I have chosen to show are specifically the pairs for today. So the pound US dollar, the Aussie US dollar, Euro US dollar, pound Swiss, pound Kiwi, and pound Aussie. This is how we choose and how I choose the pair to trade. Okay? So now we have just to wait. Now you will see, this is something I'm going to illustrate. It is not the moment to do that, but you know that we have a stop loss. So the stop loss size for the pound Aussie, so here is around 30 pips, 32 pips. And for the Aussie US dollar, so it was 15 pips, around, 12 pips, okay? If I move my stop loss, and one important rule we have for the stop loss is we never widen a stop loss. We always tighten the stop loss. So if I tighten somewhat the stop loss, let's consider, for example, for the pound Aussie, you see that the risk is 1%, minus 1%. If I tighten just a little bit the stop loss, and I will not do it too much, but just a few pips, for example, that way, you will see that the risk is decreasing. Now the risk has decreased to minus 0.82. And so we have rules to tighten the stop loss, of course. We do not tighten the stop loss arbitrarily. And the aim of the trade risk management, with a combination of the stop loss adjustment and some units clause, is to progressively decrease that risk per trade and then the global risk for the two trades in such a way to become risk-free, at least risk-free, and then possibly being in a guaranteed profitable trade. I would like to illustrate an MX with enough profit on one of these two pairs. So let's see if the market will give us that opportunity. And so there is no need to trade every day, and there is no need to try to open a trade as soon as you open your charts. Just wait for the appropriate conditions. So patience is required. And if you don't have the patience, or if you don't have the time to wait on a small time frame, because when we trade on the 5-minute time frame, this requires a lot of patience, of course, until the right conditions appears. So trade a higher time frame. And so there is no best time frame. This is often a question which is asked, what is the best time frame to trade? In fact, all the time frames are good to be traded. Just choose the one time frame or the different time frames which best suit your own time constraints. For example, if you have a normal 9-5 job, which is the case of many traders, retail traders, so choose, for example, the daily time frame, or possibly even the 4-hour time frame, or any in-between time frame, because with a platform like MetaTrader, but it is probably the same with many other platforms, you can build any time frame you want. And we have max traders trading, for example, the 6-hour time frame, or the 8 or even the 12-hour time frames. And so this really depends on your time constraints. And the time constraints comes from the profession you are practicing, comes from the activities you have or the responsibilities you have with your family. And so you may have lots of constraints. And so the best time frame for you is the one which best suits your constraint. Of course, there is always a price to pay when we choose a time frame, especially a higher time frame. With higher time frames, we have less opportunities. Smaller is the time frame, more opportunities we have, but to have a more dedicated times or activity with trading. Let me check if on our private chat room we have some questions. Hi Laure, hi Jose, welcome. Hi Randy, I have not welcomed you when you arrived in the room. So, and I'm forgetting a lot of names because we are many in the room so today, and so especially non-Max members. So I cannot mention all of you, so I apologize for that. Now, the non-farm payroll is an important news release, but there are other important news releases too. And concerning the news release, at least, of course, the news release which can create surprises and so having a big impact in the market, we have very, very strict rules, especially in the small time frame. In the higher time frame, starting with the H4 time frame, we have less restrictive rules. But the rules in smaller time frame are the following. If we are in a trade before a news release, okay, 15 to 30 minutes before the news release, we close the trade. Because in fact, we never know what the impact will be. And we do not want to be trapped in an opposite direction because the price can move very, very fast. So 15 to 30 minutes before the news release, if we are in a trade, we close the trade. Why 15 to 30 minutes? Because generally, during the last 5 to 10 minutes before the news, we begin to see some speculative movement. Not always, but this happens rather frequently. The second rule is if we have an entry setup, when we are expecting a news release, when we are waiting a news release, if this entry setup appears in the last 1 hour before the news, we skip that setup. We ignore the trade. If the setup appears more than 1 hour before the news, we can take the trade. And then a few minutes before the news, 15 to 30 minutes, we have to close the trade. For the pound Aussie, semi-quelled, the home base is acting like a support. Yeah, indeed. But it is not a surprise. It is not a surprise because remember what a moving average is. There is nothing magic with moving average. You know, there is that theory of the price reversion, the reversion to the mean, and which is explained by the fact that a moving average attracts the price when the price retraces. But in fact, if you understand the way a moving average is built, it's normal that that moving average moves approximately at the mid-level of the price movement. And so if we take a larger chart, if I make a zoom out, so you will see that here, this moving average is approximately at mid-distance from the entire range of the price movement. And of course, the volatility and the momentum create these upward and downward movement on each side of the moving average. So I don't like to consider that a moving average may act as a support or resistance. It is something that the traders consider, and they take action around this moving average in such a way that the price reacts as if the moving average was a support or a resistance. But it is the decision and the actions of the traders who create that appearing support and resistance level. So let's see if the price will succeed to push on my minimum level for the Aussie US dollar. Now the stop loss for the pound Aussie is 33 pips. So this means that the distance between the present price and the stop loss is 33 pips. Usually when we have that, and we have several rules to adjust the stop loss, but I'm not showing all the tools we are using here. This is sometimes an opportunity to somewhat reduce the size of the stop loss. And so I will do that for just a few pips, not too much. Let's see here, perhaps a little more that way. Okay, 36, 25 pips. And so by simply adjusting the stop loss, you can see that now the risk on the pound Aussie is minus 0.63. I have reduced the risk by 1/3. And so globally, also the global risk for the two trades simultaneously, so the risk has decreased by a certain proportion. But I would like also to illustrate how the risk will be greatly reduced when I will close one unit. And by the way, when we make scalings, I don't have time, and it is not appropriate today to make scalings. When we make scalings and we have to close some of these units, so the MTM, our tool, complies to the FIFO rule. So we have to close first the first open units. Now, in terms of strengths of the individual currencies, we have the strongest currency is the US dollar, but not with a lot of activity, and the weakest currency is the Aussie. So we are good with the Aussie US dollar. And concerning the pound Aussie, so the pound is gaining strength, and the Aussie is the weakest currency today. So the long trade is also well positioned, but not a lot of activity. And this is something which can seem strange. So we may have currencies which are strong or weak, but no activity, simply because there are no trades. There is no volume. What hours and days can the currency be traded? Theoretically, silver currencies can be traded every day of the week from Monday to Friday. In fact, from Sunday 5 p.m. Eastern Time to Friday 5 p.m. Eastern Time. Okay? But there is a small period of time between every day in the week between 5 p.m. and 6 or 7 p.m. Eastern Time we call the dead period. And during that period, there is virtually no trade because the big boys are not present. So, but otherwise, during the 5 days of the week, so starting the Sunday at 5 p.m. New York time, so we can trade 24 hours. So the US dollar is strong. Yes, Rami, indeed. Yeah, indeed, Vic, I completely agree, and I don't understand why they have decided to release the non-farm payroll today. just during a big holiday. It's already a big holiday for some countries. We will have an elongated weekend because Monday will be also a bank holiday. So it's strange to release the non-farm payroll today. Normally it would make more sense to release it next Friday. But it is what it is, okay? We have to comply to that. So this means that probably there will be several important revisions during the months. The reason of the revision for the non-farm payroll is the non-farm payroll is the first important economic data in USA concerning the employment and the unemployment. And they have physically no time enough to collect and to assemble all the data. So this is why the data which are released with the non-farm payroll are only approximate data, requiring several revisions along the week, along the months, while more data are collected. And sometimes there is 1, 2, 3, 4 revisions during the months. If you go on the website of the Labor Administration, so you will see the different revision and more detailed data, in fact, because all these data are publicly available. Yeah, even sometimes months later, they make some revision. That's true, right? But then these revisions are minor revisions. But the reason are they don't have enough data, and sometimes there may be errors also in the way to collect the data, because it's not an easy process. Even for a few pips, you see how the price can move very fast. So even a few pips, sometimes it takes a long time. You see, the price is only at 5 pips from my level, where I would like to close 1 unit, but sometimes it's difficult to make 5 pips. Desmond, today I have no confidence at all. Okay, because I have explained there was no clear global context due to the absence of activity. Otherwise, my main tool to have confidence in a trade is the global context. So what is the global context? The global context is all the elements which influence all the markets. And for that, I include all the geopolitical elements. For example, you know that a few days ago we have seen an incident in the Suez Canal with the boat. And so many have believed that this could increase the price of oil because of a lack of activity on the ocean transportation. Then all the central banks' decisions in terms of monetary policy with their interest rate, but also with their daily operation, then all the news releases, and then any other event which may be important, especially in day trading. And so all these helps to create two types of global context. The global context on a medium long-term perspective, and then what we call the market sentiment, which is a short-term global context. And I do that analysis every day, especially before I begin my trading session, and then I make some updates during my trading session. And then we have our technical tools, technical analysis tools, in order to time our decision. And all the tools we are using in the MAX are all important. And so there is no one tool which is more important than another. They are all important. But an indicator itself is never enough to build confidence. It's a set of concepts, so the global context, the technical analysis, and the risk management and money management. So it is these three pillars which are, when combined together, are extremely important to have confidence. So Silver asked, do you trade stocks, options, futures, and commodities on normal trading days also? Or in the past, I was also trading futures and stocks, but nowadays, since 2008, I focus only on the forex market, the currencies market. Exceptionally, I can trade indices, and very, very exceptionally gold or oil, but this is extremely exceptional. So mainly the currency, so the forex market. But in order to understand the global context, I analyze what is happening in all the market, the forex market, the stock market, the options market for some unusual level of activity in the options market, the bonds market, and the commodities market, because all these markets are interrelated and they help to understand when there is a shift in the market sentiment. Michael says also consider is the fact that when there is very little volume, the market may be more susceptible to manipulations by market makers. Yes and no. Even a small order by a retail trader can create some important movement. Because there is no need to have big orders to create an important movement. It is just enough to have a cascade of small orders in the absence of big boys to create an ample movement. So this is what we call a cascade of orders. And so you can Google and you will find some explanations about the theory of that approach. But no, there is no need of big activity to create big movement. So I see on another platform that the other pair are not moving very much too, so there is really no activity at all. So now the manipulation, Michael, does not come necessarily from the market makers, because there is a confusion among some professional traders concerning the manipulation by the market makers. In fact, I have some experience with important banks in Europe, because for 15 years, until 2009, when I have stopped my activities in the IT industries as a service manager in the software industry. So during the last 15 years, I have worked with important banks in Europe. And so in fact, in the big banks, the big boys, there are two types of traders. There are the market makers, and the market makers, I cannot say there are really traders. They propose a bid and an ask price at any moment for a set of currencies. And they have to fix, and this is their intelligence, of course, they have to fix the bid and the ask in order to maximize the number of transactions which can be made. And more transactions they will make, more profits they will make, simply by catching the spread between the bid and the ask. And then there is a second group, the money maker, in fact. And few professional traders know that group of money makers. And in fact, what is the problem of the market maker? The market maker is a very nice and very stable activity when the market is ranging in a tiny range, because they will make a lot of transactions, catching always the spread, but without creating an imbalance between their long position and their short position. But at some moment, due to some circumstances, which may be a news release, which may be a geopolitical event, an imbalance can be created in such a way that the price will move in one direction, in which case the market makers will have some difficulties to maintain their profits with the deals they are making. And then it will be the role of the money maker to handle the positions under that movement, or to create the movement in order to more easily handle their position. And of course, the money makers never trades or never reverse a market, for example, just on one candle, and certainly not on a 5-minute candle. The money makers are handling their position sometimes on many hours, many days, many weeks, many months sometimes. And so there are two reasons to consider: the long-term perspective and a short-term perspective. And so when you begin to understand the details of these two types of approach, you begin to understand that any movement in the market are not random at all. Due to using only a 5-minute chart, is there any reason to use a larger chart time for analysis, that is the trend support resistance? Oh, Chris, this is a good question. In fact, when we trade, whatever the time frame we are trading with the max, for example, here the 5-minute time frame, we have with our companion indicator, and especially the slow bias, we have a look to what is happening in a higher time frame. And so we have automatically with the slow bias a multi-time frame analysis approach, in fact. This means that in a higher time frame, and in the course we teach which time frame, so we see that in a higher time frame the trend is upward on the pound Aussie. It is downward on the Aussie US dollar. And now there is a possibility for a trend reversal, so in the Aussie US dollar. Okay? Now, in terms of trend support and resistance level, this is a difficult subject because what is really a support or a resistance level? And I have never seen really up to now a good explanation or a satisfying explanation about what is a good support or resistance level. With some other tool, more sophisticated tools which are available in the futures market, in the stock market, in the options market, in the futures market, we can analyze in a finer way the volume activity, and so we can go deeper into the workflow activity, and then we can have a better idea where supply and demand level are really located on a chart. And these levels of supply and demand are the real support and resistance level, in fact. This must be off topic for this session, but what about central banks? Would you consider them money or market makers, or are they a different category? They are important operators in the market, because you know that in fact they create an economy expansion or an economy decrease or contraction with their monetary policy, adjusting the stop loss, adjusting the interest rates when necessary. When the economy is too much heating, they increase their interest rates, and when it is necessary to boost the economy, they decrease their interest rates. But they have also daily operations, and so they can put money in the market, they can withdraw money from the market through their daily operations, especially at the open of the markets, and so you can see their activities on their website, because all these informations are publicly available. And so you will see that at certain level of interventions, they impact in the Forex, they impact in the market. Emma, what I was explaining about the real demand and supply level is the thing. I will just repeat. So the question was related to the support and resistance level using possibly higher time frames to analyze these levels. And I have explained that for me, the real understanding of support and resistance must be linked to the concept of supply and demand level. And to have a good idea where the supply and demand level may be located is by analyzing in the market when we have the real volume and the complete volume, like the futures market, the stock market, the commodities market, to analyze the order flow of these orders. And so then we can have a better idea where the support and resistance are. For the pound Aussie, Desmond, my trade is still valid, yes. For the Aussie US dollar, the trend is possibly reversing. And this is a good question. How do we consider when a trade is invalid? In fact, a trade will become invalid under three possibilities. Either a trend reversal, and to have a trend reversal, which seems to appear, we need to wait for a long entry setup. If I see a long entry setup, I will have to scratch my trade. This is the first possibility. The second possibility is to have what we call a movement invalidation. This is a concept we teach in our course. And so if I see here a movement invalidation, the setup for the movement invalidation, I will have also to scratch the trade. And the third possibility is to see a trend exhaustion, which is not the case here because a trend has not really developed. But when we have a nice trend developing, so there are some criteria to define when the trend is exhausting and then entering possibly in a sideways which may last many bars, several hours possibly. And in such a case, so we can close the trade with a result if the trade is profitable, with a loss if the trade is a losing trade, of course. But there are criteria. For the moment, I don't see a valid entry setup with the max primer and the max light. But we are approaching what we call the movement invalidation. Not yet. We have to be patient. With the max standard, this candle will be our candle setup to go long, or a long setup, but not with the max primer or the max light. And so not in the pound Aussie. But we may have this candle as our invalidation setup. What platform brokers do you prefer? It depends on the country where you live, Silver. Here in Europe, we have several possibilities as brokers, good brokers which exist for many years, who have a good reputation. Now, to trade on the Forex, I like to use, and I trade with MetaTrader, but I'm more and more considering to switch to NinjaTrader, because with NinjaTrader, at least for the currency futures contract, we may deepen our analysis, we may be much more detailed in the analysis with the workflow concept. Right. And we do not make broker recommendation because it's a heavy responsibility. It's to everyone to have his due diligence to define a good broker, because the constraints are not the same depending where you live, depending on your tax laws, depending on your constraints in terms of quality of execution of the order, depending on the market you want to trade. So, but there are a lot of websites which gives you nice review, a good review about the brokers which may exist. You have NinjaTrader 8. Yeah. What do you think? When do you think you'll come out with those? Chris, we have already almost all our indicators for Ninja, at least Ninja 7, probably not with Ninja 8. And concerning the companion indicator, we don't have them yet for NinjaTrader. They need to be coded, in fact. So we are looking for a good coder in NinjaTrader to code the few indicators which are missing. So still nothing on the pound OZ, and so possibly an invalidation. We have to wait 2 more minutes on the OZ US dollar. So you see no movement at all. If you consider the 2 long blue candles here due to the non-farm pair, we can see that now the price is inside these 2 candles. These 2 candles are engulfing so the entire price action. So no activity at all. So let's wait for the close of this candle, and then if I have to scratch that trade, I will do that in 2 steps, just to illustrate how the risk will evolve. For the moment, my risk is still the global risk, the total risk. So I will illustrate that. But personally, when I trade live, of course, in such a situation, so I prefer to stay on the trade until the price hits the stop loss, provided my global context for the trade stays valid. Because this may be simply perhaps a pullback due to some risk reduction or profit banking by some traders. And these movements are more erratic with the low level activity we have today. You see here the slopes has a tendency to become red with the price pushing a bit downward here with the pound OZ. Michael, the max standard course start next week. And the sessions are on the Thursday at 3 p.m. Eastern Time for 7 weeks. So you can contact Craig for that. Okay, now this candle on the OZ US dollar is an exit setup for a movement invalidation. And I will have to make my exit. So on this level, we have precise rules for that. I will make my exit if the price reaches that level. So once we have an exit setup, and for that we have to wait for the candle to close, we define an exit level, and if the price follows through and hit that level, we take the decision. And just for illustrative purpose, I will show the exit in 2 steps. I will make first of all an MX just to see how the risk will be reduced. Of course, we will have a loss, that's true, but just to show how the risk will be reduced. Of course, the ideal would have been to have a profit, but the market has not moved enough. So for that, how many pipettes were missing? 6 pipettes. And this is where very often many traders are panicking when the price is going against us, and when they are seeing that all the potential profit they could have made is disappearing, and when they even may experience a loss. And so many are panicking. I don't panic. I fix my exit. If the price hit that level, I push on the button. And in the meantime, if the price has a possibility to come back, so I will see the price coming back, and I will be patient. No, Chris, not for NinjaTrader yet. It's too early to switch to NinjaTrader. So because we need to get enough mastering with the platform itself, and to be sure that we have all the indicators, and all the indicators we have are working correctly. So another question, to your experience, what website would you give the most honest and considered reviews of the trading brokerage platform so that the trader could rely on their reports? Yeah, that's a good question. There is a website, probably you know, which is called Forex Peace Army. But on that website, there are a lot of negative reviews which are not justified. In fact, I have no specific website to recommend, but you can Google from that, okay? And when you read a negative review by a customer of that broker, what I observe by experience is that most of the time, in fact, the negative review is not justified. And this happens most of the time when the customer, so the trader, has had a problem in a trade, believing that the broker has traded against him, which is most of the case not the case. In fact, sometimes it may happen that the broker can trade against the customer, but this is less and less frequent. There is one broker I know who trades against the customer, but because he is itself a market maker and he recognized that, which is Oanda. And I consider that Oanda is a honest broker, but we need to know that it is a market maker. And so when you take a trade with Oanda, Oanda is your counterparty. And so when you make a profit, Oanda makes a loss. When you make a loss, Oanda makes a profit. And this is why sometimes, in fact, in order to protect their business model, their spread may be a bit large under some circumstances. But anyway, in general, when you see a negative review concerning a broker, you have to try to understand why the negative review. And very often, this is due to a misunderstanding of the business model of the broker by the customer. Now, there are some red flags I consider for a broker proposing a too large leverage like 500, 1,000, 3,000, I have seen even 5,000 to 1 leverage. Usually stay away from that kind of broker. They are a dishonest broker. Yeah, many are trying to discredit them, indeed. And if you observe over time, I remember 10 years, 15 years ago, we had many, many more brokers in the industry. Now we have way less brokers, and the remaining brokers generally are honest brokers. Of course, you may still have a problem with a broker, with an order, a specific order. But my recommendation is, once you have a broker and you trade with a broker, try to have good relations with the broker. Contact him regularly, just to ask a question in such a way that the broker will know you. And so when you will have a problem, the broker will be more inclined to help you because he knows you. He knows you. Yeah, a grain of salt, and check the time on how long ago the review is. Most of the time, it is misunderstanding or a bug that is fixed, or if it's new, a bug that got created. Yeah, indeed, Patrick. And before opening an account with a broker, it is not forbidden to ask him questions. How fast are their trade execution? What is the spread they usually have? What is the commission they have? Who are their liquidity providers? How do they handle, or how do they decide to put a customer in the book A or in the book B? Because the trade will be handled differently. So you can ask that kind of questions, and so if the broker is honest, he will ask you, he will answer your questions. You see, the price here is coming back. The price for a few pipettes has failed to reach my exit level, so I stay in the trade, and I still have an opportunity to have a winning trade. So just patience and no panic. No, I have not said I develop indicator for Ninja. We have, as you know, Vic, some of our members are coders, and so several of them have developed most of the indicators for NinjaTrader 7, but not all, unfortunately. We have, for example, the slow and fast bias, which is still missing, and perhaps one day we will have also that indicator for Ninja. If we have it for NinjaTrader 7, we will have it for NinjaTrader 8. No, you don't need to apologize. You don't need. Now it seems that the US dollar is again gaining some strength, and the Aussie losing some strength. The pound is gaining some strength too. So this is why the price is coming back. Now, what many traders are also doing, and I consider it is an error, when the price is retracing, so going against them, they begin to panic. And sometimes they resist to push on the button to close their trade, hoping that the price will come. And when the price comes on their entry level, many traders have a tendency to close their trade, because at that moment there is a kind of fear release. They feel all their fears have disappeared, and so they push on the trigger to close the trade. But for me, it's an error, because if the price is coming back, so at least at that moment there is no risk. So wait and see what the price will do. When you fix your exit level or your profit target, if you use an approach with profit target, so stick to your rule. Using a perfect trading process is one of the secrets to become profitable over time, provided you have a good trading system, of course. If you have a bad trading system, even if you execute your order correctly, you will lose. You need to have a good trading system, of course. So time is flying. So, and because we will have to wrap up in around 15 to 20 minutes, let me illustrate an MX, so closing one unit on the pound Aussie. You see, on the pound Aussie, my risk is minus 0.63%. And if you remember, in the terminal panel, the size of my trade is 36 microlots. Now let's suppose that I am in a place at a moment when I have to close one unit. It is not the case, but let's suppose that. So I will close one unit, minus 0.63. I close one unit. You can see that on the panel here, the terminal panel, the trade size has become 18 microlots. This means that 18 microlots have been closed. And you can see that the risk has decreased from minus 0.63 to minus 0.21. So the risk has decreased importantly. Of course, if I close that unit with a larger profit, most probably I would have been break-even or even with a profit. So this is the idea. And now if I reduce somewhat my stop loss by just a few pips, for example here, you will see that my risk continued to decrease. And at some point, we may be risk-free or even locking some profits. This is part of the trade risk management, okay? But I would have preferred to illustrate that MX approach on my minimum level of profit. So let's see if we will get that with the Aussie US dollar. And so in fact, what trading has taught me over all these years, I'm a full-time trader since 2008. So now it's 13 years, in fact. And the experience has taught me that the essence of trading is to assess a risk. to evaluate a risk, and if the risk is acceptable, to take the corresponding trade. If the risk is not acceptable, we are not forced to take the trade. Dr. James Pruitt, who is the inventor of the max trading system, was used to teach to his student, every day is a new fight, and you have the right as a trader to choose your fight. And so choose your trade in terms of risk. So you need to assess the risk. And if the risk is acceptable, take the risk. If you never accept a risk, you will never be a trader. But once you are in a trade, then your first priority is to control that risk, is to manage that risk in such a way to progressively decrease that risk whenever it is possible until your trade is closed or until your trade becomes a risk-free trade. And once you get a risk-free trade, then you can focus on the way to optimize the profit you can extract from the trade. And so your priority is never in the first step to focus on the profit you can make, but on the risk aspect. And this is why we have developed that tool to have a clear idea how the risk is evolving along the trade when you close a portion of your trade and when you adjust your stop loss. I'm seeing a lot of tools which are closed, which are called trade risk management, who focus only on fixing a stop loss, fixing a target profit, and so defining a potential reward to risk ratio, which is good by itself, but it is an incomplete view of the trade. And for me, a more detailed view of the trade is to have an idea, a clear idea, how the risk is evolving along the trade. Because this is key to understand when you have to take some action. For example, with the max standard trend, we have an opportunity to make a scaling. It may happen that that scaling, which has the same size as our initial entry, would add an unacceptable risk to our new position. And we can have an idea of that knowing what is our ESL result. If the risk is not acceptable, we have to skip that scaling. But if you don't have a tool giving you that vision on how your risk is evolving, you don't know when you have to take a scaling if your scaling is risky or not. Okay, does it make sense? Does it make sense? Okay, fine. Now the price seems to move a little more, and so let's see if the price will reach in the last 10-15 minutes, or let's take a little more. We are together to see if the price will reach my minimum level, because this is what I would like really to show you, how this is a very powerful technique to handle the risk. And I would like to illustrate that possibly on the pound, on the Aussie US dollar. Now, when you trade several trades simultaneously, when you have several trades simultaneously, you see if I close my trade now, I make more than 0.5% profit. And so if you are able every day to make 0.5% profit on one or several trades, and you compound and you trade every day, and you compound your profits, at the end of the year you triple your trading account by just 0.5% profit per day. Why are the two trades working? Or simply because the US dollar is strengthening and the Aussie and the pound is weakening. But as I explained today, Desmond, the global context is not clear because there is a lack of activity by the big boys, and there are no triggers in the market today except the non-farm payroll. So there are no pretext for the market to move. But my bias, I have seen with some other tools I'm using that the bias for the pound Aussie so has turned downward, and for the pound Aussie from the beginning of the day it was upward. And so this is why I stay in the trade. And when I fix an exit level, as long as the price does not reach that exit level, I stay in the trade. Okay? Now you see, let's make an MX on the pound, on the Aussie US dollar. So here, MX. You see, the risk has been reduced now to minus 0.21. My stop loss can be reduced just a little bit, so here. And now I am almost risk-free, minus 0.05%. On the pound US dollar, the price has finally reached the level I wanted. If I close the trade now, I will make a profit. Not a big profit, but still a profit. Okay? Now let's make an XXX. Let's close the second unit on this pound Aussie pair. So I close the unit. Now the trade is closed with a small profit. And you can see that with the two trades combined now, I am risk-free. And I am locking some profit. I cannot lose money on these two trades, and especially with the Aussie US dollar, which still stays open with one unit. It's impossible to have a loss today. Okay? And if I close the trade now, what I'm going to do, I will make almost a 1% profit. So it depends where the price will be, the order will be executed. So let's do that. I close the trade now. And so you can see that my total profit is around almost 0.9%, almost 1% profit. Okay? But of course, the exit I have made are not the real exit technique we have. We have the exit technique at our disposal with the max. We have around 20 different exit techniques. But due to the limitation of time, so I have shown an exit profit, an exit taking when the price has reached some minimum level. I like to wait, okay? But just to show the impact on the risk aspect. And if I watch now the terminal panel, you can see that the two orders have been closed. And if I go in the account history, you will see the details. So the two units of each trade have been handled separately with their respective result, which have been here to be profits. Okay, and you see now something is happening. I don't know what, but the price continues to move because something probably is happening around the world. It's not a news release which strengthen the US dollar, the pound, and which weaken the commodity currencies like the Aussie, like the CAD. So it seems that the market sentiment has shifted to risk on, but still with a low level of activity because of the circumstance with Easter. Okay? Now, if you are able to make 1% per day by being a little more patient, 1% per day, and if you trade every day, and you compound your result, at the end of the year, you multiply your account by 10 if you make no withdrawal. But it's a real challenge. But if you trade several pairs simultaneously, making a 1% profit, even with a 1% risk, I have chosen a 1% risk, it's not a big deal, in fact. Okay? Yeah, but if I were just a bit more patient, indeed, Michael, but time is running and we will have to wrap up this session. Okay? But the circumstances were not good to trade today, but I wanted to explain, to illustrate some of the concepts we have in terms of trade risk management with the MAX. Do you ever stay in a trade that causes swap costs? When I day trade, Chris, I never keep a trade opened overnight. Okay? For day trading, the concept of day trading is to close your trade before the end of the day in order to avoid two problems: the swap problem, so the interest rate you have to pay or you receive, and to avoid also an insane increase of the spread. Because sometimes the spread becomes so large that your stop loss may be hit simply by the spread increase. Okay? Okay, Jeff, I hope you have enjoyed this session. Okay, any questions before we wrap up this session? So not a big active session because a low level of activity, but some nice opportunity to illustrate some of the concept of the max. And you see in concrete patients, when you have some context explaining why the price is moving in some direction, but today the context was not clear, then you can have confidence in your trade. And this happens 4 days out of 5 each week. And every day, at least from Monday to Thursday, I establish the global context for the for day trading. Let me show you if I can illustrate that how this happens. So I have to open here in my Gmail this. Oh, it has been already erased by our friend Chris. So just a moment. 90%. So every day, from Monday to Thursday, usually I take Friday off for the 7 major pairs, Euro pound, because we are still in the post-Brexit situation. And 9 of our top pairs list, plus 5 stock market indices, 2 commodities, gold and crude oil, and on 2 bonds, the 10-year Treasury bond and the Euro bond. So I establish a bias, a directional bias with down red arrow or green up arrow. And depending on the reliability of the bias, the global context bias, I have 1, 2, or 3 arrows for each pair. And whenever, perhaps I can show you on an example when I save every day, when I close my trading session, I save that spreadsheet, and I will show you how it looks like. Just a moment. Intraday bias. Let's take, for example, yesterday, which has been a very, very difficult day because, again, no clear bias. Just a moment. Here, in the short-term bias, so we have the saving in an Excel spreadsheet is not always correct with due to the Google, but we have, you see, for example, yesterday for the Aussie US dollar, my bias was 2 down a row. For the let's say the US dollar CAD, 2 up a row. So short the Aussie US dollar, long the US dollar CAD. And whenever I change or I establish a bias, the bias is time-stamped. So the time when the bias has been established is automatically printed in the sheet here. It is New York time, and so I may possibly change the bias several times a day, depending on the market sentiment shift, if there is some shift. And similarly for the long-term bias, for those who trade higher time frames. So I establish a long or a short bias for all the 28 pairs plus the 5 market indices, gold, crude oil, and the Treasury bond. And when I have time, also the VIX, which is the volatility index on the Standard & Poor's 500. And so these bias are not available for free. There is a small monthly subscription, but I trade based on these bias. And so I always trade in agreement with these bias. So if for a pair my bias is to the downside, I will take only short trades when my slow bias is red. If my bias is long, I will take only long trade when my slow bias is green. And now, if we ignore the global context, the winning rate of the max is around 70 to 75%, with approximately 20% of losing trades. 70 to 75% winning rate is a nice winning rate, considering that we don't have 25% or 30% losing trade, but only around 20%, the rest being break-even trades. with a reward to risk ratio of around 2 to 3 to 1 with the max standard, we have a nice positive expectancy. If we consider the global context and we trade in agreement with the global context, what I observe since we established this global context, day after day, we trade less often. Approximately we trade between 1/3 and 1/2 less, but the winning rate jumped to 90 to 95%. And there are many days when I have even 100% winning rate. And so with the global context, the winning rate becomes really amazing, fantastic. So, and we trade with much more confidence. So understanding the global context is a real big edge in any trading process. So let's see if there are some questions. Desmond, you are asking if the Max is working on NinjaTrader. Yes, for the moment, the Max works on NinjaTrader 7. For the NinjaTrader 8, I'm not sure, but we don't have all the indicators. 1 or 2 indicators are still missing. Okay, otherwise the Max works on NinjaTrader. Michael asks, I follow your entire real-time trading action. Top. Okay, thanks. Ah, you are from Ghent. Oh, yeah, Michel, Marnou. Yeah, I recognize your name. I have friends in Ghent, by the way. 2 friends. Thank you, Eusebio and staff. This has been very interesting. Okay, thank you very much. I hope you have a wonderful weekend and please stay safe. Yeah, thanks, Silver. You too. And by the way, all of you, I wish you, of course, to stay sane and to stay safe in this very specific period, which may be a great, difficult period for many of you, unfortunately. But this may be also an opportunity. Trading is an opportunity we can exploit because it does not require a lot of resources, just a PC with 1, 2, or 3 monitors, a good internet connection, and a trading account. And there is no need to have a big trading account. And you can work from home. And so whatever the circumstances, provided internet is still working, and so the trading business is still working, so we may have, we may in fact be independent on these said circumstances. So I don't trade bonds. I would like to trade bonds, but I take into account the bonds market behavior, Silver, because the bond market is also a very important market. And by analyzing how the bonds market is moving, we can have a very quick idea if the market sentiment is risk on or risk off. Because what happens is the following. What is the concept of risk on, risk off? Let me take just a few minutes to explain. We say that the market is risk on when the traders, the big traders, in fact the big boys and the traders in the big hedge funds have a tendency to trade or to invest in the most risky assets. For example, in the stock market or in some types of commodities. And we say that the market is off when they perceive some global risk and they prefer to trade or to invest in safer assets, like the bonds market. And so if we see the bond market improving, we can deduce in a very simple way that the market sentiment is risk off. If the bonds market, if the bonds price, not the yield, the price is going downward, we can quickly define that the market sentiment is risk on. Now, we can make a finer analysis by observing also the relative behavior of all the yields of all the bonds. If you take, for example, the US bonds market, you have the 1 month, the 3 months, the 1 year, the 2 year, the 5 year, the 10 year, the 20 year, the 30 years treasury bond. And so by analyzing more carefully how these yields are evolving, you can have a finer idea if the market is risk on, risk off. If you add then the analysis of the correlation with other markets, like the gold market, like in the futures, in the currencies market, in the forex, what is happening in different group of currencies, you can better define if we are risk on or risk off. The currencies may be classified into three categories. One category is what we call the speculative currencies, which are the CAD, the Aussie, because they are linked to some other assets like oil or like gold, for example. And then we have what we call the safe haven currencies, like the Swiss, like the yen, like often the US dollar. And so when you observe which currencies in these groups are stronger, then you can say, okay, the market is risk on or risk off. If the safe haven currencies like the Swiss, the yen become strong, we can say probably the market is risk off. If the CAD, the Aussie, the pound are strong, we can say, okay, most probably the market is risk on. And then you can analyze the other markets, or making an intermarket relationship analysis, you can have a clear idea in which direction you have to trade and which assets to trade. And the bond market in this context plays an important role, because don't forget, the bond market is a huge, huge market. It is a market which is traded by important investors having big portfolio, and these big investors are rarely wrong. And so the bond markets, when analyzed carefully, gives very clear indications. Okay? So this was a small macroeconomic lesson, and I hope you will enjoy that. What about the precious metals and commodities market? Yeah, for the precious metal and commodity market, I observe the gold market, the gold, and silver also. Sometimes I look for silver. For the commodities market, I also observe oil, but that's all. That's enough. Even if I don't trade them, they give important information about the market sentiment, risk on, risk off. In a risk-on situation, gold has a tendency to go downward, and oil to go upward, and vice versa. But it is not always the case, because these two markets are also small markets. They are highly manipulated, and so there are many other circumstances which can make the price moving in the opposite direction than the direction we are considering. I have seen these days many situations when the market, for example, is risk on, and the price of gold was going upward, and vice versa. And so gold does not always move in the direction of that concept of risk on, risk off. There are sometimes situations when the market is risk off and the price of gold is still going downward. So this is why having a multiple view on all the markets is really useful. Okay? My pleasure, Miquel, my pleasure, and hope to see you soon too. Silver, agree. Nice to see you agree, Silver. Okay, it's time to wrap up, because I have been a little bit too long, and Craig will complain because the video will be a bit longer to produce, so I apologize with Craig. So I thank you very much for your participation today. I hope you have enjoyed the explanations and the demonstration. Stay safe. You and all yours, your family and your friends, your neighbors and so on. Stay sane also, because these markets nowadays are sometimes completely crazy. And see you in another opportunity. And in the meantime, I wish you a very happy Easter. So see you next time and take care. Bye.